Hello everyone, if you're struggling to build an accurate narrative, this is the video for you. Welcome to a full breakdown trade on Euro versus the US dollar. Before we start, let me address a few things. As ICT or CRT traders, we have three main objectives. First, we need to determine the high time frame draw on liquidity. Second, we must build a narrative. Third, we must position ourselves towards the high time frame draw on liquidity, which we achieve by taking a trade after it has been purged. Determining draw liquidity is fairly simple. You need to find the correct dealing range, match it with the correct key levels and range dynamics within a suitable seasonal tendency. You then choose a high or low depending on the framework you have built, and that becomes your higher time frame draw on liquidity. As I have taught you, there are two types of draw on liquidity: short-term and long-term. Both follow the same sequence, but involve different variables. So far, I have mostly taught you how to determine draw liquidity in past levels of CPI. I will also produce a separate weekly chapter on this topic, providing a step-by-step approach on how to determine draw liquidity correctly. This will include the timeframes we will use, and this topic will be covered in either Level 4 or Level 5. Some of you are already familiar with this, so it won't be an issue for you. The third part, which is taking entries, is also fairly simple. I have shown you how to take different types of entries based on various models. I have shared my personal model with you, which is the Model 1 entry, an order block entry that I use myself all the time. Additionally, I will share other entry models in Level 4. You can test these models, assess their effectiveness, and determine whether they suit you. The biggest challenge that most traders face, and the main issue holding many of you back, is the second objective: building a narrative. This is the hardest part because most traders are unfamiliar with it, and it involves many variables that can create conflicting signals and ideas. To build a sharp and clear narrative, you need strong anticipatory skills. I will create a separate chapter dedicated to building a narrative, but in this video, I want to provide a brief summary of what narrative means, how to build one, and the factors you need to consider to ensure it is accurate and precise. Essentially, a narrative is the idea of knowing how and in what manner price will move toward the high time frame draw on liquidity. It also involves knowing when price will reach that liquidity. You might be right about the draw on liquidity, but still struggle with accurate entries because you don't know how price will move there or in what order. Without this understanding, you would be lost in price action. This is where narrative becomes crucial. Narrative helps identify market profiles, key levels, and catalysts for expansions or reversals. It provides clarity on the how and when aspects of price movement. To build a narrative, we use several key concepts. The most important is the Open High-Low Close, OHLC concept. We also incorporate market profiles, weekly and intraday profiles, the power of three, dealing ranges, and PD matrices. Finally, we integrate all these concepts into a logical framework, matching them with key levels and higher time frame CRTs. For example, if the draw on liquidity is higher and you are looking for long trades, you don't simply enter a trade as soon as the daily candle opens. That would be pattern trading, which is not reliable. Instead, you wait for the Asian session to end. The Asian session typically forms a ranging profile or accumulation phase, where liquidity is generated. This is not an ideal time to take an entry. You never want to enter when liquidity is being engineered. During the first half of the day, including the Asian session and CBDR range, you avoid trading. This is part of building a narrative. We understand this through the OHLC concept, which tells us that after a candle opens, price typically starts by forming a ranging profile to generate liquidity. This applies to all time frames, whether it's a 4-hour, daily, weekly, or monthly candle. Once liquidity is generated, price enters a manipulation phase where liquidity is purged. During this phase, we test a higher time frame key level and purge a CRT at a key time. After this manipulation, we form the low or high of the candle. Next, liquidity is neutralized as price either expands or distributes toward the draw on liquidity. We know this process through the OHLC concept, and it helps us build a structured narrative. In addition to OHLC, we also use intraday profiles and market profiles. The market never moves in a straight line. It follows a sequence of ranging, manipulation, expansion, and retracement before continuing toward the draw on liquidity. Understanding this helps us avoid trading during accumulation phases and only participate during manipulation or liquidity-neutralizing expansions. Your objective is to trade only during the manipulation profile, when liquidity is purged at a key time, or when price is expanding or distributing toward the draw on liquidity. You must also align this with the correct key times and kill zones before entering a trade. After matching this with a CRT, you only take a Model 1 entry after the CRT is purged at a key time. Once an order block forms, you take your entry with a predefined stop loss and exit strategy. If you lack a strong narrative, you won't know where to look for entries. You might randomly select candles as CRTs, which will likely fail because you haven't built the correct narrative behind them. This is why I didn't immediately create a chapter on CRTs. Before you can choose a CRT correctly, you must first understand market profiles, OHLC, intraday profiles, weekly profiles, dealing ranges, and more. Only when these concepts are integrated into a logical framework can you accurately select a CRT. Choosing a CRT correctly is the easy part. The challenge lies in building the necessary context and narrative behind it. Many traders ask me how to choose a CRT correctly, but I can't give a simple answer. It requires an understanding of multiple concepts before you can make the right decision. This is why I have taught you about market profiles, OHLC, intraday profiles, and dealing ranges. These elements are integral to selecting a CRT. When combined properly, they give you an edge over other traders. Many traders don't understand this because they are learning from the wrong sources, which fail to teach these essential aspects. Next time you ask how to choose a CRT correctly, remember that the answer lies in building a proper narrative. If someone tells you otherwise, they are wrong. The only way to select a CRT accurately is by constructing a solid narrative using the concepts I have outlined. Keep this in mind as you refine your trading strategy. Let's look at the charts and see what we have on the weekly time frame that led me to taking this trade. If you remember from the last breakdown, I had this weekly FVG as my short-term drawn liquidity before price started moving higher again. For the first half of the week, price was moving lower toward this drawn liquidity. But then what happened is that we had an SMT divergence with DXY. What happened next was that we saw non-symmetrical price action between these two correlated pairs and assets. As a result, DXY filled and tested the weekly FVG, but on EU, price never tested the FVG. Instead, it formed a divergence and a discrepancy with DXY. Now, if you have studied the chapter I made on divergence, then you know that this type of price action is what we call non-symmetrical price action. This is because price created a discrepancy or divergence. We also know that non-symmetrical price action indicates that the current order flow price is in will be unable to continue, making a reversal likely. And that's exactly what happened. After we had this SMT divergence, the bearish price action we were in, moving toward short-term drawn liquidity, was unable to continue. After that, we reversed and moved higher until the end of the week. The thing about SMT divergence is that it stays valid for the time being, which means this SMT divergence played out perfectly for the rest of the week. Now, when the next week opens, price is going to enter a new cycle. At that point, you will need to analyze the price action again based on the variables and frameworks I've taught you. From there, you'll determine new short-term and long-term liquidity levels for yourself. Because of this SMT divergence, I changed my drawn liquidity for the rest of the week to a bullish one. And for the remainder of the week, until the market closed, we continued moving higher. My drawn liquidity for the previous week turned out to be correct. On Wednesday, I was looking for bullish trades and bullish CRT on the 4-hour time frame, which aligned with my thought process on the higher time frames. Now let's look at the 4-hour time frame to see how I position myself in a CRT toward the higher time drawn liquidity, which was bullish for me. So right here on the 4-hour, you can see that we had this SMT with DXY on Tuesday, right, and then we closed higher. On Wednesday, my expectation was to look for higher prices for the rest of the week due to the SMT divergence. This divergence signaled non-symmetrical price action, and we know that during such market conditions, the current order flow is likely to be unable to continue, leading to a potential reversal. That's exactly what happened. However, during Wednesday, I couldn't take an entry right away because that would have been pattern trading, which should be avoided at all costs. Instead, I waited for the price to reach the London Open kill zone, meaning I waited for the right time and allowed the ranging profile in the Asian session to end before considering an entry. I also waited for a CRT to form and aligned it with a key level before taking an entry on the 15-minute time frame. During the London Open, the market ranged without anything significant happening. Then, during the London lunch session, when a key 4-hour candle formed, I took the CRT trade. This setup occurred inside a 4-hour FVG, purged a key level, and happened at the key London lunchtime, specifically the 6 a.m. candle. Once this purge occurred, I began looking for a Model 1 entry. This process is what we call building narrative. I built this narrative using the open high-low close concept. Based on this, we know that before price expands higher, it first opens and generates liquidity in the first quarter of the day. Once liquidity is generated and a ranging profile is established, the market manipulates below that liquidity, purges it, and then forms the low of the candle. At the same time, it tests a high time frame key level and forms a CRT. In this case, the low of the day formed at a key time, London lunch. At that same time, the 4-hour CRT was also in play, and we had tested a 4-hour candle. Everything aligned perfectly within a logical framework. After that, I waited for the CRT to be purged. Once that happened, it matched my high draw liquidity target, and the narrative I built was clear. When the Model 1 entry was confirmed, I took my entry, targeting the high time frame draw liquidity. That was the trade breakdown. Traders, I hope you understand this chapter. If you have any questions regarding this video or CRT in general, please write them down in the comments. Be sure to backtest this or any other trading strategy you find on Flames and Trading. Once you're satisfied with the results, be sure to forward test your favorite strategy on a demo account. Remember that nothing in this video should be considered financial advice. This is purely for informational purposes. If you haven't already, please consider liking this video and subscribing to my channel so you don't miss out on future content. I upload an indicator video every Wednesday and an ICT Concepts video every Sunday. I'm currently making a mini-series on candle range theory, which is what I trade on a day-to-day basis. If you would like to keep up to date with my trades, then follow me on Twitter and join my Telegram. Thanks for watching. Till next time, happy trading.
Would you like to earn up to $10,000 just from sign-up bonuses? How about copy trading alongside professional traders like myself and these experts right here? With ByteFi, it's easier than ever. That's not all, there's no KYC required for all regional users. Plus, you'll enjoy a lifelong 20% cashback on every trade you make. And when you sign up, you'll also get a 10% deposit bonus. This totals 30% of your total trading budget. The link is in the description below.